So, hello, and a massive hello to everybody. Hope everybody's having a great weekend wherever you are, whatever you may be doing. This is 50 pips, rocking and rolling here, 21st of October, 2018. No trade calls, recommendations, or response for their own stuff. We're here for educational purposes only. So, what's happening as we go into an interesting week? So, keep in mind we've got an awful lot of earnings this week, notably Amazon and Google on Thursday. We've got BOC and ECB, both with press conferences too. And again, we're going into a market that's showing a little bit of volatility picking up, decent amount of two-sided action both ways, fairly technical action. And on the currency side, a market where the DXY has been strengthening and where overall the market is predominantly still very long USD. So we should see an interesting week ahead. If we start by looking at the market, so let's see if we can prop up our chart. Just as a reminder, because I don't want to keep on laboring on about this, but it's really important, right? So here we got our three indices, so S&P, Dow, Russell, and the NASDAQ. So what you want to watch for from a day close or from a week close perspective are these key pivotal numbers. So it's the 2700 on the ES, the 25,000 on the YM, the 7,000 on the NQ, and then it was that 1600 on the Russell. Now, you see what happens. You see the acceleration once we go through these pivotal numbers. And look at how technical this is, right? Beautiful little action. We accelerate through the pivotal number. We come back in. Sellers come right in. And it's trying to continue down in extensions. And if any point you see a day close or a weekly close below these levels, you'll see a lot of people selling hard, right? Now, I already suspect the market has shifted to sell the rallies rather than buy the dip, but especially if you get these daily closes here, a lot of, CTA, systematic funds, etc., just the general tone is going to really switch to pretty much most people, if not everybody's going to be looking to offload or sell rallies. So this is really, really key. So especially if you get those day closes below here, expect to see the same kind of action that you've seen on the Russell. Okay, very, very interesting action across the board. Now, I still think that one of the most interesting trades out there is a combination, or one of these two is the Nikkei and the Nikkei shorts and the Japanese yen shorts. We discussed this in detail. I mean, we were on this pretty much when we started to hold back below those previous highs on the Nikkei, and the move has been very, very nice, because you see on the move back down, essentially what's happened is we've come down about actually a total of about 7-8%. Now it's hovering at -6, but there's clearly, that's just halfway gone, right? There's the same thing on the indices. If we continue to correct, at the very least we're just halfway done. So you see here we've come back down, we're hovering pretty much at mid of this range, and our expectation is that this failure is going to give us at a minimum back into this low end of the range. And again, if this continues, and if you start to see markets continue to trade heavy when the market is predominantly still very, very long USD, and especially against the yen, here there's a lot of potential to go. And this is another one of those classical trades where you have what we look for, which is asymmetry, right? On that weekly close back below the 114, that's your risk, and this is your reward for a move back to the bottom end of the range, similar to this kind of range. But our expectation, reminder, hasn't changed, is on a risk-off tone across the board and an ugly move on equities. We expect to see yen come all the way back into that 100 mark. So again, risk, should you catch a lottery ticket, reward, these are very, very nice trades. Now, remember that in terms of the equities, what we've seen is just a little bit of a correction so far. So it's not the end of the world yet, but it pays to book your profits, right? So I think here we probably see a little bit of a relief in Italy going into the week. And so this is just a reminder for those of you who are on the MIB trade, is that we would really not be pigs, right? Here, the assumption was that this failure at these highs has a potential to come all the way back to the bottom end of the range. This is a gigantic correction, but you don't want to be a pig. We'd be taking profits here to reload higher for a continuation, but we would not be pressing shorts here. And it's the same thing as we saw on the trade on the YM, right, which clearly can extend. But remember, the percentage play essentially on this trade is done, right? You don't want to be a pig. Remember, right? Very nice. Another one of these with very, very nice risk reward on the trade, risking under 2% to make over 5%. Back a correction into that 50. This is done. If anything here, the next leg of the trade is in play, but you don't want to be a pig. And again, it doesn't always work out perfectly like this bounce that you saw on the YM, because the Russell trade, this this clearly extended far beyond where we thought it was the percentage play was on the TP. But again, you can't complain. It's a nice trade. 1.5 risk for it's the same, exactly same trade. But you see, when you're looking at this in a technical fashion, because price doesn't only move in a straight line, even though you missed this by taking profit on the trade being done here, you still had a chance to get back short, as we discussed on that for the next leg of the move. But again, it's markets extend going cocaine angel at times and just go one way down, but it's not the way markets tend to move. So we'd always prefer to go with a on the side of the cautious move on the percentage play move, and not try and be too aggressive. Okay, now going back to some of the interesting things that we would be focused on going into this week is, keep in mind, as we said, we have those earnings coming out, right? So don't be surprised if you see rips or pops. That's what you would expect to see, especially on Thursday when you've got Amazon, you've got Google reporting, right? But what you want to watch out for is what we can call the Netflix sickness, right? And it's what we've discussed, essentially, not to go through it as far as we're concerned. Netflix broke quite a while ago. But here you see what happened. You get the earnings come out. They beat, everybody's surprised. You get a massive move higher. Actually, overnight, it was a silly move. I think it was like up 20%. But off that close here on Netflix, stalled. Let's see if we can get it to work again. Right, in the next day we popped up about almost 10% if you look at during the day. And then what happened, we gave it back. We discussed this in detail in the videos. We discussed this on Twitter. We said, you got to watch out. If it gives it back, it's sayonara, baby, right? You got to be very, very cautious. And if you start to see this action, which we've seen in previous earnings cycles, right? If you start to see this more and more, if you start to see it, especially with Google, with Amazon on Thursday, then it's probably a sign that things are going to get much, much worse before they get better. Here, this is a very, very ugly pattern, especially after that gap up. This is pointing to the fact that we have unresolved business taking out these lows. And as our base case being, since here we've got unresolved business all the way back down here. So that's something to keep an eye in terms of the earnings. I had a lot of questions on crude. Crude, the problem is here, what's going on in terms of possible headline risk if things heat up, if there's sanction on Saudi Arabia, God knows what. So if you forget all the headlines, this is a beautiful little move, right? So we came right back into this level since we broke higher. If you remember, we said we had absolutely no interest to try and short crude. We're going to wait for the right level. And as we pressed through that 100 here on the monthly, what we said is, this is you've got this big trend line, and it started to back off, and it was a very nice line. We said this is where you get aggressive if you want to get aggressive on this crude trade, right? And actually, you can see this is the chart we posted, right? This is when it was trading. We sent this out. See, right into that level, it started to back off. And what's to keep in mind here? Well, you've got the descending trend line. You've got that short-term action. You've got the chance to put on what we call, what we say, we're always looking for that asymmetry. You got a chance to risk this much, right? Tiny little risk for even if you're getting a move back into the next moving average or even to the next cluster, you've got extremely nice reward on that kind of risk. On top of it, you're going into what we've discussed as a seasonally weak period on crude. So we don't know what's going to come out on the headlines, but if you look, you've got this, and at the same time you see it trying to rip here, reacting right on the level, moving right back down below the moving average, it's worth a shot. You don't have to get a lot of these with that kind of risk reward for it to pay out on balance. So here essentially looking at crude, this is in play, right? It's in play. So as long as we don't get a funky headline and we keep on getting closes below the 70, then expectation would be for it to move back down into one of those moving averages, move back down to this previous big resistance that should act to support, or possibly all the way back down into the 50 back of this move up. But it's a very tricky call because of the possible headline risk. I wouldn't necessarily be looking at the 50 back here. I would be looking at this previous high, this level, and probably expect it to kind of stall here if it's going to come down maybe the 60 mark. But this trade is still in play. Now, we've got this is support, this is resistance, and then it's all down to what kind of headline risk we see coming out. Now, as we said, there's an awful lot of what we got, DXY, right? So we've got two central banks reporting this week, and what's happening on the DXY. Well, on the DXY, we're not going to change our tune. As always, we're letting the chart guide us. So our base case is still that it's trying to form some kind of a top here, even though it's a little bit funky. Some people are going to be talking about some kind of shampoo bottle, God knows what. We don't really look at that, but if you look at it in a weekly, this remains our control chart, right? So I think you can make an argument for both sides, but we're going to stick with the way we're looking at this. And our base case is, even if this stays very, very choppy, unless we get a weekly close above this level, we still expect this to be a choppy and resistance zone that ultimately holds for this to come right back down and test these 92.60s. So we're not going to change our tune on that one. And the other chart most people are looking at or discussing is the Euro USD, right? With the usual doom crowd about Euro going to sub 1, etc., etc. So far, it's still holding on quite well, right? You can see here on this on the weekly that essentially not a lot has happened, right? Once we broke down hard, we had very aggressive attempts to keep it under and smack it down for those lows. And if you remember, this was our long setup also going into the end of the year. This tied in with the last Fed decision. This tied in with our long golds. Now, keep in mind that this also played out quite nicely with seasonal. So the back end of the year is not great for Euro. But right here, what's happening? We're coming right back down in all this previous resistance zone that's acting as support, right? So some people are going to be drawing shampoo bottles again. We're not huge fans of looking at those kind of patterns. But unless we do not break down hard and quick, the base case has to be that, again, DXY 60+% Euro, the base case has to be that unless something concrete comes, we're still going to be in a sloppy way or fashion stuck inside this range, with the 1550, 1500 being some kind of sloppy support, and the 1815, 1800 being a much nicer resistance than the support is. So watch this going into the week, going into Draghi. As long as these lows hold from a closing basis, you would expect this high to get tested very, very quickly. If that goes in a squeeze, remember the market is still predominantly long USD. Do not be surprised to see us rip all the way back into those highs. If sometime during Draghi or because something that happens, we close the day or we get traction below these lows, then the only logical expectation would have to be that the 113s get tested very, very quick. And then it becomes really interesting. But right now, as long as these hold, you'd expect us to try and probe these highs. Now remember, going into the ECB, the market's going to do the best job it can of taking out weak longs and weak shorts. And if you look at the most recent range, really going into this ECB is we're talking about something here. So that's where, this is where the weak shorts are, and this is where the weak longs are. And that's what likely the market is going to be very tempted to play around and test. Okay. Now, again, going into this week, I think the most interesting thing to look at is still the equity market, and we still feel there's a potential for a much bigger correction to come into play. If you look at the SPX, we're still stuck here. So our base case has to be a reminder that this is the chop area, that this is the chop area. This is a false break. Any rally for that after that is a sale for us for a move back down into the opposite side of the range. Mid was defended very nicely, so now we have to see if the box is still going to be, oops, didn't mean to do that, if the box is still going to be defended to get that test of these lows. Now you will see that if you just put on the basic moving averages on here, let's see if it's going to load them. We're stuck at that 200. I don't think that 200 is that important here. I think here what matters is the mid-range of the box, okay? Where I think the moving averages are a lot more interesting is, and you see these 100 and the 50 are coming in line with the top end that needs to be protected. But I think where those moving averages are far more interesting is if you look at the weekly, right? And you see here the 50s trying to hold on the weekly. If this goes, look how pure these are lining up. The 100 comes into play. If the 100 comes into play, then the 200 comes into play. Our base case hasn't changed on all this rip. Our base case is still that the whole Trump rally, because of the way it occurred and because of the state of liquidity in the market, etc., and the complacency, if we lose these lows, we think there's a fairly good chance that the whole Trump rally, A to B, is going to, the market's going to give it all back. And that base case for us hasn't changed for a long time. Okay? Wishing everybody an awesome week again. Thank you for flying with 50 as usual. Have an awesome one. Talk to you guys soon. Take care. Bye-bye.